The Institute for Financial Literacy is a collaboration between MoneySense, the National Financial Education Program, and Singapore Polytechnic International. The Institute is the outreach arm of MoneySense. We conduct free and unbiased financial education programs for the public. MoneySense is Singapore's national financial education program set up in 2003 and is currently overseen by MAS, Monetary Authority of Singapore, and MOM, Ministry of Manpower. MoneySense aims to help Singaporeans manage their money well and make sound financial decisions on their own. Understanding Real Estate Investment Trusts, REITs. This is the second video in a series of 2 on understanding REITs. In this video, we will look at the benefits and risks of investing in REITs and how to select REITs. Benefits of investing in REITs. These are the benefits of investing in REITs. Diversification. REITs typically own multiple properties with different tenants, so they reduce the risk of being exposed to a single property or tenant. As such, they can be used as proxies for property stocks when building a diversified portfolio. They also allow investors to diversify geographically, as some REITs own assets in other countries. Affordability. For a relatively small outlay, investors can gain exposure to a variety of properties held by a REIT that they would not normally be able to afford on their own. Liquidity. Unlike physical property, which can take many months to sell, REITs are traded on SGX, so investors can easily buy and sell whenever they want. Transparency. Since REITs are traded on SGX, prices and information about REITs are readily available. Furthermore, REITs are subject to the SGX's listing rules, so their disclosures have to be timely, transparent, and comprehensive. They are also subject to stringent corporate governance regulations. Passive income. REITs are required to distribute at least 90% of their taxable income each year in order to qualify for tax exemption. With a REIT, you can earn passive income from investments in real estate without having to actually buy, own, or manage the properties yourself. REITs versus property stocks. Here are the differences between REITs and property stocks. Business focus. REITs own income-generating properties, whereas assets owned by property stocks need not necessarily be income-generating. Custody of assets. For REITs, assets are held by the trustee, while for property stocks, assets are held by the company. Dividend policy. For REITs, they have to distribute at least 90% of net income. For property stocks, dividends are at the discretion of the board of directors. Leverage guidelines. REITs borrowing is capped at 50% of deposited property. For property stocks, there is no borrowing limit. Investment guidelines. At least 75% of the REIT's deposited property should be income producing and 90% of income derived from rentals or interest. There are no guidelines for property stocks. Here are more similarities and differences between REITs and property stocks. Risk and other considerations. Having discussed the benefits of investing in REITs, we now turn our attention to the risks and other considerations. Market risk. Market risk is sometimes called systematic risk, which is risk that cannot be diversified away. Examples would be a sudden natural disaster like an earthquake or the onset of a global pandemic like COVID-19, an unexpected rise in interest rates, and an unpredictable economic downturn. Interest rate risk. Generally, higher interest rates are negative for REITs because it raises their interest payments and refinancing costs. Also, higher rates mean higher bond yields, which could lead to REITs being less attractive. However, it depends on how highly geared a particular REIT is, the tenure of its loans, and whether the interest rates for those loans are fixed or floating. Income risk. If a REIT makes an operating loss, no dividends are possible. This means investors should look at the stability of a REIT's sources of income. Investors should also check the REIT's loan refinancing terms. Loans to REITs usually have short tenures, usually 2 to 5 years, and the principal amounts are not reduced as only interest is repaid. Because loans then have to be rolled over at maturity, investors should check if the REIT has many loans maturing at the same time or if they are staggered. Concentration risk. This risk arises if a REIT has a large proportion of its assets in only one area, class, or geographic region. It is important for investors to check and read the risk factors in the REIT's initial public offer prospectus before investing. Other factors to consider. Here are some other factors to consider when evaluating REITs. Income support. Some sponsors provide income support for their REITs to tide them over their first few years. This will boost distributions or dividends per unit, but this could be only temporary. If this support is withdrawn, the REIT's income may fall. Investors should consider whether the REIT's manager has taken steps to mitigate this risk. The outlook for interest rates. As discussed earlier, if interest rates rise, the REIT, being a yield instrument, will likely experience a price fall. Also, higher rates mean higher interest costs, which would affect profits. Dilution risk. If the REIT's gearing is near the limit and it is looking to expand, it would have to issue new units through a rights issue. This is usually at a discount to current prices and could be dilutive to existing unit holders. Yield. Investors should not focus only on the yield offered by a REIT. They should instead ask why any given REIT might have a high yield. Could it be because the market is selling that REIT, thus depressing the price and raising the yield? Alignment of interests. Does the manager's compensation method ensure interests are aligned with unit holders? Overseas properties. Many overseas properties mean having to juggle different laws from different jurisdictions. It also means the REIT's income will be subject to currency fluctuations. Domicile of key personnel. Accountability of key REIT officers and personnel could be a problem if they live overseas. Key considerations before investing. These are the key considerations before investing in a REIT. Make sure buying into the REIT fits with your investment objectives, risk profile, and investment horizon. Check on the risks associated with the REIT by reading the offer prospectus and research reports issued by stockbrokers and other analysts. Study the quality of the assets owned by the REIT as well as the quality of the management. Check the REIT's gearing ratio and its debt maturities. Compare the potential return and risk offered by the REIT with other yield-generating instruments. Look at the REIT's tenants and occupancy ratios. Make sure you understand the fees the REIT has to pay and its income distribution policy. Do not invest in a REIT you do not understand. How to select and value REITs. Having discussed the benefits, risks, and considerations when investing in REITs, we will now look at how to select and value REITs. There are many ways to select REITs. Some of the more common ways are the top-down approach. This method starts by selecting the country, then the industry, and then the specific REIT. By comparing yields. As noted earlier, a REIT's yield may appear attractively high, but this could be because its price is depressed because of selling pressure. By examining growth potential. Investors should read the REIT's offer document and research reports to gain an understanding of its earnings growth potential. By checking its gearing ratio. Highly geared REITs are generally considered riskier. Investors can make use of the SGX's stock screener. Valuing REITs. When it comes to valuing REITs, the most common methods used are yields, net asset values, capitalization, discounted cash flows. The yield-based method. This approach compares the REIT's yield with a risk-free rate. The most commonly used benchmark for the risk-free rate is the 10-year yield on Singapore government securities, such as the Singapore Savings Bond or SSB. Assuming that the 10-year SSB's return is 2.71%, if the REIT's yield is 6%, then investors have to ask themselves if the premium of 3.29%, 6% minus 2.71%, is reasonable, given the REIT's earnings and growth potential versus its risks. Investors can track the spread between government bonds and a REIT's yields over time to see how the market perceives the REIT's riskiness over business cycles. Ultimately, it is up to the investor to decide whether a REIT's yield is sufficiently attractive, given the risks and rewards. The net asset value method. Net assets are the market value of assets minus liabilities. This method is popular because REITs are asset-heavy instruments, and the Monetary Authority of Singapore, or MAS, requires a REIT's assets to be valued at least once a year by a professional valuer. However, it is important to check that the valuer's assumptions are realistic, or whether it is just extrapolated from current conditions. Capitalization rate method. A REIT's capitalization rate is obtained by dividing net operating income by market value of the assets to give the rate of investment return. This is then compared with other REITs and the risk-free rate. The discounted cash flow method. This method requires estimation of distributions for the next 5 to 10 years, and then discounting them to their present value using an appropriate discount rate. Here are the key takeaways. REITs offer many benefits such as diversification, affordability, and passive income. REITs are exposed to many risks such as rising interest rates, fluctuations in rental income, and over-concentration in certain markets or sectors. Among the methods to value REITs are those that focus on yields, net asset values, and discounted cash flows.